Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN for Wednesday, December 4th, 2019. Here are our top stories. The financial markets, looking back at 2019, and then what can you expect for 2020 and the year ahead? And let's welcome in Dr. David Kelly. He is the Chief Global Strategist for JP Morgan Asset Management. Dr. Kelly, it's great to see you this morning. Happy Thanksgiving and happy holidays.
Same to you. Very glad to be able to do this.
Yeah, it's great, and you're joining us from Massachusetts, and we appreciate it. Hopefully, it's not too cool where you are, but let's jump right in. So this has been obviously a very interesting year. Wondering if you wouldn't mind weighing in with your thoughts and the sentiments of JP Morgan Asset Management on kind of the year that was. I think that'd be really interesting for the audience.
Well, the funny thing is, it's, the markets and the economy are very rarely exactly in sync. They're sort of on different time schedules. This is kind of like me and my kids when they were teenagers. They wake up at different times and go to sleep at different times. So when you look at what actually happened this year, the economy actually slowed down relative to last year. I mean, by the second quarter of last year, we were growing 3.2% year over year. Now we're growing about 2%. We haven't seen any increase in inflation. It's pretty steady. Unemployment's very low. But earnings growth has really slowed down. And we've had 3 quarters with very low earnings growth. So everything's kind of slowed down in the economy. But if you look at the market had a terrible fourth quarter of last year. And then it's just been moving higher all year. And so for investors, this is turning out to be a very good year. But for the economy, it's kind of blah. And that's just the way it is. These things aren't always in sync in the short run. But I think in summary, it's been a great year for the market, but not so great for the economy. Yeah,
that's certainly positive for those people, individuals who have 401ks and IRAs who are saving for their financial futures in retirement. Are there, obviously there's a lot going on geopolitically, and we don't really want to talk too much about politics, but how much of an impact, Dr. Kelly, are political, what's going on in Washington, D.C., the impact with the conversations and tariffs with China and other nations? I mean, does that have a broader impact to the U.S. market and to our economy?
Yes, it does. But let's keep a few things I'd like to say. First of all, you're quite right. Let's not get too bogged down in politics. 2020 is going to be a very political year. I've always believed that the correct way to invest is to not let how you feel about politics overrule how you think about investing. I've seen too many people be too partisan and miss out on good opportunities because of it. And then I think you also have to separate the political noise from the trade issue. The trade issue has actually been very important because this escalation in the trade war, these tariffs on China, the sort of on again, off again tariffs with Mexico and threats on Europe, that has slowed down the global economy. I mean, the problem is that businesses just don't know what to do. And if they can't make decisions because they don't know what to do, they do nothing. And that has slowed down investment spending. Now, it so happened that the U.S. economy had a head of steam coming out of 2018 because of the tax cuts. Yep. And so it's a kind of a case of two wrongs make a right here, where the economy really did need to slow down. And we didn't think, it's not great to slow down this way. But what's actually happened is the global economy slowed down really hard because of the trade war. It has hurt our exports. It has hurt our investment spending. It slowed the U.S. economy down. But because the U.S. economy had so much momentum going into it, that it's just sort of slowed it down to about 2% growth. But I do think the problem with the trade war is not very evident to consumers. Consumers are doing okay. But for businesses, it has really slowed down investment spending. It's really slowed down exports. It's hurting with business planning. So it is a problem.
Let me shift gears. We're in the holiday season. We just wrapped up Black Friday, Cyber Monday. Obviously, it's a very important part of the year for retailers. But we've also seen many retailers like JCPenney and others maybe shutter some stores, close down. Toys R Us comes to mind. Would you mind weighing in a little bit on the retail sector? That's a very important sector for our economy.
Yeah, it is. And I mean, it's a big sector for employment. There's just a big structural change going on in retail. And it's really between retail and wholesale is what's going on here. Because the advent of Amazon and online shopping is really hurting bricks and mortar retailing. And I think that's going to be very evident this holiday season. I think overall retail sales will be okay. They were pretty good by historic standards. But much more was going to be online, and that's going to put a lot of pressure on traditional retailers. Now, the thing about traditional retailers employ a lot of people. In relative terms, wholesale outlets employ a lot fewer people. I mean, if you think about it, if you're working for Amazon, how often do you sit around? Like never, because you're always moving stuff from where to where. But if you think about the average retail outlet in the mall on a Wednesday morning, how many people are sort of sitting around, nothing to do? And so in some ways it makes the economy more productive. I'm not sure that it's great in terms of personal work experience for people. But it's just a transition. It's not saying that the economy is doing better or worse. It's just we are moving from a retailing model to much more of a wholesale, deliver to your house as soon as possible kind of model. And that's really what's going on here.
Yeah, that's a really important point, and people should definitely take note of that. It's kind of a recalibration. Dr. Kelly, you and your team do a fabulous job with you create a guide to the markets. I believe it's every quarter. I know I'm a big reader of it. Are there particular asset classes or things that you have seen and you and the team have seen that have done particularly well in 2019? I don't want to get to the prognostication yet. We'll come to that in the second quarter. But are there particular things that you have seen as a team that have done particularly well?
Well, thanks for the shout out for our guide to the markets, by the way. We do produce it every quarter, but we actually update it every day now online. Wow. By 10 a.m. So, for any financial advisor out there, just log on to our website. You can get it by 10 a.m. every morning, and we update all the numbers. When we look at the numbers, it's been a very good year for U.S. stocks. Again, I think it's been a good year for global stocks, but U.S. stocks have generally beaten global stocks. We have seen some tilt towards financials and towards value stocks recently, so that they have done somewhat better. It's also been a surprisingly good year for the bond market. I mean, we have seen some pickup in inflation, but the Federal Reserve got nervous about global trade pretty early on, and they got nervous about the sell-off in the stock market at the end of last year. So they cut rates 3 times. And so we've actually seen long-term interest rates come down about 1% from the start of the year. So bottom line is, year-to-date, we're up about 25% in U.S. stocks. We're up about 8% on U.S. bonds. We're up, mid double digits. We are up double digits in international stocks. So it's been very good for global stocks, but generally U.S. stocks are still leading the charge.
And that's a good sign. I mean, many pension funds, people who were saving for retirement, it used to be, Dr. Kelly, that we would prognosticate or say, well, use 8% as a return on investment. I mean, this is back when I first started in the business, back when I had hair. But, you'd start at 8%, you use 8% as a real return. It seems like over time that has gone away, or it's not as the best rate of return. Are there different asset classes? So we see pensions. I guess my point is, I'm getting to it. My point is that we've seen pension funds and endowments and foundations and others use so-called alternative investments, which we've covered on the show. Is it just based on your assessment of the market, can we expect real returns to be below that 8%, and then therefore there be some additional ways to find quote-unquote yield to improve a return on the portfolio?
Absolutely. It is terribly important for people to realize that a plain vanilla 60-40 U.S. stocks bonds portfolio has done wonderfully well over the last decade, but it's not going to do wonderfully well over the next decade as far as we can see. And it's not a knock on the economy or anything. It's just where we start from. We're starting from above average valuations in the equity market. We've got full employment. We've got low earnings growth. That makes it hard for stocks to grow in the U.S. And then in the bond market, we start out with 10-year treasury yields below 2%, below the rate of inflation. From there, you're not really getting any real income. And if inflation ever does come back, you could lose some money. So that doesn't work so well. It's not giving a lot of income. It's not giving a lot of growth potential. So yes, in terms of income, we do look to alternatives, things like real estate, infrastructure, transportation funds. If you can access those types of areas, you can get some extra income. I think also, in some ways, stocks are the new bonds. I mean, there are a lot of stocks which are relatively stable. They pay dividends. Companies are buying back the stock. And actually gives you a fairly good total income stream. And then when it comes to growth going forward, I think people just need to look at international. I know it's lagged behind and everybody hates it because it's lagged behind, but you've got to be forward looking here. And as we look forward, we think international will outperform US stocks over the next 5, 10, 15 years, and people need to make sure they're not underweight international stocks in their portfolios.
Yeah. One last question for this segment, Dr. Kelly. We have been covering sustainable or ESG investments. This is obviously a very important trend that we're seeing both domestically here in the U.S., but I would imagine internationally as well. Any thoughts about sustainable investing? I have to think that there's potential there for returns and opportunity for investors.
Well, I think there is. I mean, I think that you've always got to make a calculation when it comes to investing as to whether what's right for the planet is really right for is going to actually prove to be profitable. And so we've had a swing towards some populism and nationalism in a way that may do less for social or environmental causes in the short run. But in the long run, we do need to have better, there are lots of technologies which are much more energy efficient, which are much less polluting. Those are going to be the technologies of the future. So I think there are a lot of opportunities there. It's a good place for people to look for part of their portfolio as a way not just to grow money, but also to actually help the planet.
Yeah, we're going to take a break, and when we come back, we're going to talk to Dr. Kelly about what we could possibly expect. And I want to underscore the word possibly, so stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back, and we're talking to David Kelly from JP Morgan Asset Management. Dr. Kelly, thanks for sticking around with us again this morning.
Happy to do that.
Oh, great. So we talked about kind of the year that was, but would you mind sharing what you and the team believe could happen the remainder of the year and into 2020?
Yeah, well, obviously it's, I think that investing is really much more like climatology than weather forecasting. And if you try and forecast the weather a few months ahead, it's really hard. If you try and figure out what the climate's going to be over the next 10 years in a particular place, well, you kind of know that. And so it's short-term forecasting is very difficult. But I think what's going to happen over the next year, the most important thing to recognize, I suppose, is how politics is going to become more dominant. And there are political differences. I don't want to, I try to be nonpartisan in this, but clearly if the president is reelected, maybe, I think we'll still have tight restrictions in immigration. We'll have perhaps a more aggressive stance on trade. If a Democrat is elected, we could have less of that, but then more perhaps the potential for higher taxes on upper income individuals and corporations. And all of it depends on whether you get one-party government or mixed government or divided government. So that's going to be an issue. That uncertainty is going to be hanging over markets. I think overall the economy should be able to avoid a recession. And that's surprising because this is already the longest expansion since the American Civil War. But when we look at it, we just don't see the sort of boom that would actually cause a bust. We don't have too much capital spending. We don't have a huge boom in cars or houses. There's nothing in the economy which really is set to keel over here. So we think the economy will move forward slowly. We think interest rates will stay relatively low, but perhaps move up a little bit from where they are right now, because we think inflation will remain pretty solid and actually pick up a little bit. And then I think U.S. equities could do okay. There'll probably be a little bit more volatility than we saw this year. But I also think if trade tensions diminish even slightly, I think international economies ought to do a good deal better than they're doing right now. And so this could be a year in which the dollar finally begins to come down a bit, and we see international equities do a little bit better than U.S. equities. All of those themes, though, are really ones which we feel much more comfortable espousing for the next 5 years than for the next 12 months. It makes much more sense in the long run to say, yeah, the dollar's too high. In the long run, it's coming down. In the long run, the rest of the world is going to grow faster than the United States. It's almost certain to. And in the long run, interest rates ought to be higher than they are today, because nobody's getting paid in real terms on these long-term bonds, and that doesn't make sense. So it's harder to make the short-term points than the long-term points, but those are the trends we see.
And then in terms of the Federal Reserve, they always play an important role, whether some of us like it or not, but they are very active. I mean, raising rates, lowering rates. Do you have a thought or thoughts as a team on rate increases or decreases going into 2020?
Well, I actually think, you say that they're active, and they have been active in the last few years, although they have not moved rates up or down as much as they have in the past. I think the Federal Reserve would really like not to change rates at all this year. They raise them to to what's historically still a pretty low level. Then they cut them 3 times by 0.75%. So we're now below 2% again on a federal funds rate. I think they'd like to stay that way all the way through the year. First of all, I think that they think that's about right for a slow-growing, low-inflation economy. But second of all, I think they want to keep out of the political fray. I think that one thing that all the Federal Reserve chairs, from Jay Powell back to Ben Bernanke and Janet Yellen, they all believe in the independence of the Fed, the importance of the independence of the Fed. They would like to stay out of politics, so that politics stays out of their business also. And so I think that's what they're going to try and do, and basically stay low during the election season of 2020.
Yeah, and let's hope they can do that. Oftentimes, I mean, with Twitter and social media, oftentimes it's hard to be out of the crosshairs, and a lot of people can point fingers. Bonds, in terms of fixed income. So one of the challenges that in the retirement industry, as you know, because you're out speaking to many financial advisors and many plan sponsors, the deaccumulation is a huge topic for plan sponsors, people who are thinking about taking money in retirement plan, and therefore you would think that bonds would be somewhat of an important component to that. Any thoughts about the bond environment and also the drawdown, the retirement income component?
Exactly. Well, I mean, it's a very difficult time for fixed income investors, and it doesn't seem that way, because after all, fixed income has given you about 8% so far this year, but it's done it as long-term interest rates have fallen by about 1% in an economy with a 50-year low in the unemployment rate, with wages rising. And that's a very unusual situation. It's partly because people are just pouring money into bonds. It's partly because central banks have been so easy. But if you start with these low yields, I mean, the best predictor of the long-term return of bond is its current yield. The current yield in a 10-year treasury is 1.75. So 1.75% over the next 10 years is not a great return. So I think people need to be cautious about bonds. I mean, you have to have a stable part of a portfolio. I think it's worth looking at. First of all, if you've got a certain amount of cash in your account, make sure that that's invested in something that's pretty good. I mean, you can put, people don't think about it, but there's a difference between 0.5% and 1% and 2%. Yeah. So I think, first of all, get that right. Second of all, I think people should look at equity income, look at dividends as a way to get income as well. I mean, the dividend yield now is above the yield in 10-year treasury bonds. And also foreign stocks pay higher dividends than U.S. stocks. That's another way to get dividend income. And a third thing that I think people should think about is, there's no law that says you can't sell principal. In fact, a lot of people don't want to sell principal, but if you're decumulating in a low inflation environment, and that means you say you're going to get a 4% income, say, every year, and if that means you're selling some growth stocks on the way up, that's okay. That's all right. So long as the overall so long as you've got a portfolio that's correct in terms of total risk and total return, if you have to sell some principal in the way, if it's not just coupons and dividends, there's nothing wrong with that. I think we have to get out of that mindset that that you can't ever sell principal. So I think we have to be a little bit more inventive there.
Yeah, absolutely, and that's a huge area of concern, as I said, for the industry, and you know this as well. And I guess more to come on that as people create new products, new services to help with that drawdown. Dr. Kelly, always a pleasure seeing you, talking to you, and hearing your perspective. Have a wonderful holiday, and we will certainly talk with you very soon. And that wraps up this episode of BRN AM. Hope you enjoyed it. Hope you found it educational. Have a financial topic or someone of interest that you think we should take a look at and interview? Drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, so much more, check out today's edition of The Morning Pulse. So until tomorrow, keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired of the same